Many people think of gifting their assets once they have passed away. But what about when you're still living? What about if you have children that can really benefit from a gift today rather than waiting for an inheritance in the future? Why are beneficiaries not all equal? And what accounts should we be designating to different beneficiaries for in the future when we do pass away? Join us as we talk about this on Consider This Program. Welcome back to Consider This Program. I'm your host, Jamie Burton.
And I'm Aaron Rheaume.
So great to have you here today, Aaron.
Yeah.
Today we're talking about planning with the end in mind. And we really want to dive into what about if we want to gift to some of our loved ones before we pass away, before they are having an inheritance? What's the best way to do that? And how do we make sure that the beneficiaries that we have listed on our accounts are what's best for our loved ones, the people that we leave behind? Are we really helping them with their inheritance, or are we going to potentially hurt them if we don't do the proper planning? So I know with kids, we both have kids, and we know how expensive it is to have kids growing up. But once they get to a certain age and they're out on their own, they might still need some help with different expenses that they have, whether it be buying a new home, having a down payment, or getting married, and they want some help paying for the wedding. What are some good ways that we can give to our children to be a benefit to them, but also possibly being a benefit to ourselves?
Yeah, great question. And I love the topic because it's unique for everybody. And so when we do these shows and record our educational content, we do so from an educational base, but it's not as we're doing it because it's a one-size-fits-all approach.
Absolutely.
And so when we help people through this, we try to tell them it's a journey and they're unique. And so just as if you were asking me that question, if you were sitting down in front of me, I would try to figure out how we could help you from a position that's going to help better your family. And so that is a great question. And, you know, for my family today, I've got 3 daughters, 13, 10, and 8, and leaving them something today would not make the most sense. But what you brought up is what could help potentially in the future, so like a wedding or buying a home. You just really have to look at it, and when I do talking, it all comes back to the tax. And so are there ways that you could potentially eliminate future tax? And we'll get into some more of that based on the IRA passing and those types of things. But for most people, you can give $16,000 a year to anybody. So I could write you a check for $16,000 if I had that in the bank account, and you could receive that check with no strings attached, and you don't pay tax on it. And it just depends on where that's coming from. So if it's cash, no strings attached, you could take that. I could also write Chad a check. So you, between the two of you, you could essentially have $32,000 worth of donations or gifts. Now, if you're going to look at it from an asset standpoint, we have to realize what type of asset that we're going to give. So it could be a stock, it could be something else. While you're still living, you have to think about some of the tax consequences of that gift. And so if you're to pass let's say an asset, like we talked about earlier, an appreciated asset, there's things that you potentially have to worry about. So if you pass that while you're still living, your children would inherit your basis. So if you bought a stock for $10 a share and it's worth $100 today, that $10 would be their basis. So if they sold that, then they would have to recognize capital gains based on their income. Had that happened after the time of passing, they get a step up in basis. And so you just have to pay attention to what it is you're giving, like I mentioned, and everybody's gifting is unique to their family situation.
Absolutely. And like you mentioned, the tax situation of the person gifting and the person receiving is the key. You have to make sure that if you're gifting to your children and they're in the same bracket or a higher tax bracket than you are, that's not really the most efficient thing that you can be doing. That's not the best for you or for your loved one. So you really have to sit back, take a look at what's going on in both of your situations. As Aaron said, it's unique for every person that we sit down with to really determine what is the best strategy for you at the time, if it is really on your heart to make a gift to your loved one. And tying into that, we look at gifting when you have passed away. And we want to make sure that when you have passed away and you're leaving assets to your loved ones or to charities, that you're giving it in the most efficient way possible and that you're not actually hurting your beneficiaries instead of benefiting them. So that's why we say that not all beneficiaries are equal. Can you go into that a little bit more, Aaron?
Yeah, another great question, and another situation that has to be evaluated with a lens. Just take your kids. They all probably have different personalities and they interact differently. The same thing can happen from an income standpoint. And so maybe there's a child that is a surgeon, and you have a child that is a teacher. Both very, very good careers, but from an income standpoint, they're noticeably different. And so when you're leaving assets, especially tax-deferred, which would be IRA, tax-deferred portions of 401ks, and you have other assets, let's say maybe you have Roth IRAs, which are tax-free, or taxable accounts, you really want to take a deep dive on what you're leaving to each one of your kids. Now, in this situation, it may make the most sense to leave the Roth IRA, which is tax-free, to the higher income child, and having some of that tax-deferred money go to the lower income, because it wouldn't, the overall tax benefit you wouldn't have as much tax going to the lower income, and so as you potentially would with someone earning more.
Yeah, absolutely. So just because you have two kids that you love the same doesn't mean that you should be leaving them equal assets, because from a tax standpoint, when you have a higher earner than a lower earner, it's not going to even out. It's not going to be the same, and it's going to potentially hurt the higher income earner more than it's going to benefit them, because it could potentially bump them up into an even higher tax bracket. And that's not what we want to do. That's not what you've worked so hard to save for and leave a legacy for your family. The last thing you want to do is hurt them in any kind of way. So we want to make sure when our families come in that we're really evaluating that situation. We want to make sure that we're having those discussions about their beneficiaries and what their beneficiaries do, what their tax situation looks like, so we can make sure that we are doing the best thing for them. So Aaron, I had a family come in the other day, and they had some tax-deferred assets, so some IRAs, some Roth IRAs, and then they also had a trust. And inside their trust, it had laid out that they want certain percentages to go to their kids, certain percentages to go to their grandkids, and then a certain percentage to go to their church out of their trust. Is that the most efficient way for them to leave assets to their church?
It just depends on what they're leaving, and again, for those families, it's all unique. What I would tell you without seeing the statements is probably one of the most least beneficial assets to leave to a church would be, one of the most beneficial assets to leave to a church would be an IRA. The reason for that is the church or charity doesn't pay tax on that gift. And so if you do have IRA dollars, Roth dollars, and dollars that could be inside of a brokerage account in a trust, you want to make sure if you're doing any sort of giving to give the IRA portion, whatever that equals out to the church. And so there's just so many things to think about when you're doing your gifting strategy. And there's an ever-changing tax code. The other thing, too, and I want to hit on this real quick, is because we're on the topic of beneficiaries and planning with the end in mind, there was a major rule change that happened in the end of 2019 with the Secure Act, and that's how beneficiaries receive assets now. So if you receive an IRA or a Roth IRA, in the past it used to do what was called the stretch, and so you could take out a yearly distribution based on your age and life expectancy. Well, what changed is that window was condensed to a 10-year time period, and that is for both Roth and IRA dollars. And so all of those dollars have to come out by the end of the 10th year. And so with that in mind, again, that creates another beneficiary situation. You have to be paying attention to income tax, not only for yourself, but for your children as well.
Absolutely. So imagine that you have $1 million IRA and you have the beneficiaries listed as 50-50. The first 50% is for your son. The second 50% is for your daughter. Imagine that your daughter is a high income earner. She's a doctor. And then you have your son who is an artist. He loves what he does, but he doesn't make as much income as what your daughter's making. So each of your kids have inherited this $500,000 from your IRA and now have to take that out within 10 years. Can you imagine the tax brackets, the tax consequences of adding 10% of that $500,000 each year, not even counting in there any kind of growth inside those accounts, to each of your kids' tax returns? To the artist, he's going to think it's great. He's going to enjoy that $50,000 and it's not going to hurt him a lot on his taxes if he's a low income earner. But adding that $50,000 to your doctor daughter on her tax return, that can make a really big impact and really hurt her tax return. And that's why we say that not all beneficiaries are equal, because your daughter's getting far less benefit out of that $500,000 IRA inheritance than your low income earner's son having that $500,000. So that's why it's so important to us to discuss that not all beneficiaries are created equally. That is just a small part of the conversation that you need to have regarding your financial plan, and especially that legacy portion of how you want to gift assets today and how you would like to gift assets in the future. If you want to get into that a little bit further, please reach out to us. We are happy to have that conversation with you. You can get a hold of us at 800-928-4001. You can ask for Brittany. She'll talk to you, kind of explain the process and what we do. She can schedule you for a next step meeting with one of our advisors. We're going to talk to you about the 5 critical elements that we know if you miss one of them will break your retirement. You can set up a next step meeting where we will talk about what you can do today, what you need to do in the future, and if you partner with FEG, what we will do for you going forward.